Let me start by asking you, just how cautious are your clients right now?
Well, actually, they are looking for weakness in markets to perhaps purchase. I mean, not very cautious. They see pullbacks in the markets as opportunities to buy. I mean, if you look at what's happened with Wall Street in the last 9 months, it surprised everybody, with a huge rally. So I think the economic picture has not changed dramatically. Economic picture is still quite positive. Earnings is still coming through. With the correction recently, valuations have now become a bit more attractive. So I think there are no reasons to be terribly negative on risk assets or equity markets. There are reasons to be cautious, but there are no reasons to be extremely cautious on the markets. So the way I see it, on significant pullbacks, I think you want to dip your toe into the water, not jump in aggressively, because, I think no one really knows what's going to happen in the next 6 to 9 months in terms of the macro headwinds. You've got trade issues, you've got European issues, you've got US dollar interest rates, these are all still playing out. Yeah? And so you can be assured there'll be more volatility, and that volatility can create buying opportunities. So you don't want to fire all your bullets, buy gradually. That's what we're saying.
Let me just pick up on some of those points, because I can't help but feel that the market is underestimating the balance of risks, as you painted out quite eloquently, whether it's from trade tensions getting worse, whether it's from the dollar continuing to strengthen, or whether it's from a higher oil price and the risk of even $100 a barrel. Doesn't that all imply a far more defensive posture is really needed? Because right now, arguably, if you take the strategy to its logical conclusion, we're picking up the proverbial pennies ahead of the steamroller.
Well, I mean, I don't think it's going to be that bad of a steamroller. I mean, yes, the US dollar is at risk of, appreciating a bit more from where it is right now. It's already appreciated a lot. We don't see it going up by leaps and bounds. I mean, if you look at the real effective exchange rate,
do you think we're seeing peak dollar then?
We're not saying peak dollar. In the short term, dollar could see a bit more upside, but it's rallied like 7-8% so far this year. We don't see another 7 to 10% rally from here. A bit more upside, because of the fact that markets are focused on interest rates. But if you look at the real effective exchange rate of the US dollar, nominal effective exchange rate of the US dollar relative to its long-term history, we are very close to the peak.
Is there more stress then to come in the emerging market universe? Because the way I see it is that we will only really see meaningful stabilization within EMs globally if we see the dollar hit an inflection point, if we see the dollar turn lower.
Precisely, I think we're not ready for that yet. I mean, the dollar is still bouncing at the very top. It's not pulling back in a big way. The dollar rallied 9% this year, and then pulled back 3%, and then rebounded recently in the last couple of weeks by 1%. So we haven't really found the dollar bottom yet, especially with the Federal Reserve is talking about high interest rates, and Wall Street is heading higher. So I'm not suggesting the dollar has really peaked. I think nobody can really tell where the peak is, but I think the upside for the dollar from here, another 10, 15%, 30%, that's I think unthinkable. I mean, it's probably going to be single digit, if anything at all. I think, as you said, if the dollar turns the corner, heads south, that's going to give some relief to emerging markets. I think we need to see that happen before we are really bullish on the emerging markets.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.